As we said, the German financial system at the moment is stable, but we all know that things can escalate, either on the military front or sanctions, or in the way energy is delivered for one reason or another, right? Which means that the economic situation is fragile. We're already seeing that growth is down to somewhere around zero in many jurisdictions, including here, and it's vulnerable. It's also vulnerable from the ongoing COVID-related shocks. We've got an inflation which is going to need to be tackled, and it's going to need to be tackled now. So that's a cocktail which is, difficult for the economy, and especially if you look at the energy-intensive sectors or the sectors with a lot of dependencies on commodities, things could get difficult in those sectors. So, whereas in the pandemic we were looking maybe at certain sectors on the services side of the economy, when you're looking at this situation, you're looking more at the industrial side of the economy and saying where could there eventually then credit problems arise. At the moment, the system looks stable, but we know that escalation can bring turbulence with it.
What could it mean for the banking sector? Because clearly that's your remit and your supervision area, especially given that there is a high risk of higher interest rate and something which we used to call a taper tantrum years ago, right?
Mm-hmm. Yeah. I mean, there are various risks from the interest rate environment. If rates were to stay very low for a long time, that's difficult for parts of the financial sector. Think about life insurance and retail banks as well. If there's a shock or a very rapid move up in interest rates, you have other problems, sometimes due to the way the banks refinance themselves, and sometimes, and what you could foresee, is corrections in the markets that look rather overvalued at the moment. That's from real estate in Germany through to share prices around the globe. We've seen some corrections, maybe in technology and certainly in government bond markets, but there's certainly seems to be more risk to downside. Then the question is, where's the leverage in the system? Do we understand it? And what's being provided out of the banking system to other parts of the financial system that's maybe hidden? We saw last year with the case Archegos how one case of providing leverage to another financial player can cause billions of losses across the industry. So we have to be very wary about what's happening at that interface between the bank and the non-bank sector.
And that's what you're trying to do as well in your everyday work? Do you have dedicated teams who are looking at potential sources of risks out there?
That's right. Part of our modernization is trying to look forward at what might happen under various scenarios. We'll test a low interest rate scenario and an interest rate shock scenario. They can't both be right, but we need to know who's exposed against which scenario, and are they adequately capitalized? Are the buffers in the system adequate for that? That's what a modern supervisor of the financial sector should be doing, looking at the potential scenarios and testing them, and then interacting with the companies, the financial companies.